Hey everyone, welcome back to the channel. Today, we're diving deep into the exciting world of the Indian stock market. Whether you're a complete beginner or just need a refresher, this guide will equip you with the essential knowledge to start your investment journey. We'll cover everything from understanding the basics to exploring different investment avenues, analyzing stocks, managing risks, and taking that first step towards investing. So, let's get started. First things first, let's demystify the stock market. Imagine it as a giant marketplace where companies list themselves to raise capital by issuing shares. These shares represent ownership in the company, and you become a shareholder when you buy them. In India, we have two primary stock exchanges, the National Stock Exchange (NSE) and the Bombay Stock Exchange (BSE). Think of them as platforms where buyers and sellers come together to trade stocks. Now, you might have heard of terms like Sensex and Nifty, which are market indices reflecting the overall performance of a group of stocks. Understanding these basic concepts is crucial before you even think about investing. Now that you understand the basics, let's explore the various investment options available in the Indian stock market. First up, we have equity shares, which represent direct ownership in a company. When you buy shares of a company, you're essentially becoming a part owner and stand to gain if the company performs well. Next, we have mutual funds, which are professionally managed investment vehicles that pool money from multiple investors to invest in a diversified portfolio. Then there are exchange-traded funds or ETFs, which are similar to mutual funds but are traded on stock exchanges like individual stocks. For the more experienced investors, we have derivatives, financial instruments whose value is derived from an underlying asset. Lastly, we have bonds and debentures, which are debt instruments issued by companies or governments to raise capital. Each investment avenue has its own risk and reward profile. So, it's crucial to choose investments that align with your financial goals, risk tolerance, and investment horizon. Now, let's understand how to actually participate in the stock market. To buy or sell stocks, you need a Demat and trading account. Think of a Demat account as a digital locker to hold your shares electronically, while a trading account is like your gateway to the stock exchanges. You'll need to open these accounts with a registered stockbroker who acts as an intermediary between you and the stock exchanges. Once you have your account set up, you can start trading. There are two main types of trading: intraday and delivery. Intraday trading involves buying and selling stocks within the same trading day, while delivery trading means holding stocks for the long term. Remember, trading involves risks, and it's important to have a sound strategy in place before you start. Now, let's talk about the two main approaches to analyzing stocks: fundamental analysis and technical analysis. Fundamental analysis involves evaluating a company's financial health, management quality, industry position, and future growth prospects. Key ratios used in fundamental analysis include the price-to-earnings (PE) ratio, earnings per share (EPS), debt-to-equity ratio, and return on equity (ROE). Technical analysis focuses on studying historical price and volume data to identify patterns and trends that can predict future price movements. Popular technical indicators include moving averages, relative strength index (RSI), and moving average convergence divergence (MACD). These indicators help you identify trends, momentum, and potential buying or selling opportunities. Both fundamental and technical analysis have their own strengths and weaknesses. It's important to use a combination of both approaches to make well-informed investment decisions. Investing in the stock market involves risks, but there are ways to manage and mitigate those risks. One of the most effective risk management strategies is diversification. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, sectors, and companies to reduce your exposure to any single stock or sector. Another important risk management tool is setting stop-loss and target prices. A stop-loss order automatically sells your stock when it hits a predetermined price, limiting your potential losses. Remember, the stock market is inherently volatile, and prices can fluctuate in the short term. Investing with a long-term perspective and a disciplined approach can help you ride out market volatility and achieve your financial goals. Understanding the regulatory and taxation aspects of investing is crucial for every investor. In India, capital gains from stock market investments are taxed under two categories: short-term capital gains, STCG, and long-term capital gains, LTCG. STCG tax is applicable on gains from investments held for less than 12 months, while LTCG tax applies to gains from investments held for more than 12 months. Additionally, there's a securities transaction tax, STT, levied on every buy or sell transaction on the stock exchanges. It's essential to be aware of these taxes and factor them into your investment decisions. Consult with a financial advisor or tax consultant to understand the tax implications of your investments and optimize your tax liability. Now, let's explore some common investment strategies that you can consider. Now that you have a good understanding of the basics, let's explore some common investment strategies that you can consider. Value investing involves identifying undervalued companies with strong fundamentals and growth potential. Growth investing focuses on investing in companies with high growth potential, even if their current valuations seem high. Dividend investing involves investing in companies that pay regular dividends to their shareholders. Index investing involves investing in index funds or ETFs that track a specific market index, such as the Nifty or Sensex. The best investment strategy for you depends on your financial goals, risk tolerance, and investment horizon. It's important to choose a strategy that aligns with your individual needs and preferences. Now, let's move on to understanding market timings. Understanding market timings is important for executing your trades effectively. The normal trading hours for the Indian stock market are from 9:15 a.m. to 3:30 p.m., Monday to Friday. However, there are also pre-market and post-market sessions. The pre-market session takes place from 9 a.m. to 9:15 a.m. and allows investors to place orders before the market opens. The post-market session takes place from 3:30 p.m. to 4 p.m. and allows investors to place orders after the market closes. While the normal trading hours are the most liquid and see the highest trading volume, pre-market and post-market sessions offer opportunities for investors to react to news and events that occur outside of normal trading hours. Now let's move on to the final chapter, where we'll guide you on how to get started with your investment journey. Congratulations on making it to the final chapter. Now that you have a solid understanding of the Indian stock market, it's time to put your knowledge into action. The first step is to open a demat and trading account with a reputable stockbroker. Choose a broker that offers a user-friendly trading platform, competitive brokerage fees, and excellent customer support. Once your accounts are set up, start learning and researching. There are numerous resources available online, including educational videos, articles, and courses. Start small and gradually increase your investment amount as you gain experience and confidence. Don't invest more than you can afford to lose, and always have a well-defined investment plan in place. Stay updated on market news, trends, and company announcements. Remember, investing is a journey, not a destination. And that concludes our comprehensive beginner's guide to the Indian stock market. I hope this video has equipped you with the essential knowledge and confidence to start your investment journey. Remember, the stock market can be a powerful tool for wealth creation, but it's crucial to approach it with knowledge, caution, and a long-term perspective. Now you're ready to start. Open a demat account, research well, and invest wisely. Happy investing, and I'll see you in the next video.